Ladies and gentlemen, thank you for joining us on episode 22 of Bullish. Remember, anything we discuss is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. I'm Sam Hardy, joined by the usual crew, Nick Stenger and producer O. We are Stenger Family Office. For the past 43 years, it has been our mission to deliver clarity and confidence to help secure your financial future. If you haven't already, be sure to like, subscribe, share the show, get the clarity, the confidence, the good news out there. Joining us today is somebody you've probably already seen on any or all news outlets. He is a world-renowned economist, author of Stocks for the Long Run, Dr. Jeremy Siegel. Welcome to Bullish.
I'm happy to be here. Thank you.
Dr. Siegel, welcome. You are the man, the myth, the legend. You really don't need an introduction, but we're going to give you one anyways. Okay. Dr. Jeremy Siegel is a senior economist for WisdomTree Asset Management, a $100 billion plus asset manager in New York City. He's the Emeritus Professor of Finance at the Wharton School of the University of Pennsylvania. Professor Siegel has written and lectured extensively about the economy and financial markets and is a regular contributor to the financial news media. And in 1994, he received the highest teaching rating in a ranking of business school professors conducted by BusinessWeek magazine. His book, Stocks for the Long Run, which many of you know right here in front of us today, was one of the 10 best-selling investment books of all time. His second book, The Future for Investors, was a bestseller as well, and his research on dividend investment strategies is in that book, coinciding with WisdomTree's development of its original family of dividend-weighted stocks ETFs, the first of which launched in 2006. Dr. Siegel has also been instrumental in helping guide the Stenger Family Office investment process. I think that's the most important thing we want to convey. And what we'll start off with the most, getting duration in our fixed income portfolio down to next to zero in 2021 before it was a cool thing to do. So, Professor Siegel, how did you know that inflation was going to go up and not be transitory?
Oh, absolutely. I mean, I taught, before I joined the Wharton faculty, I taught 4 years at the University of Chicago. I was a colleague of Professor Milton Friedman. I idolized him. I mean, I had read all his books on monetary theory and policy. I saw the money supply explode. And I remember Professor Friedman telling me, he said, Jeremy, if you're going to have an explosion of money supply, 12 to 18 months later, you're going to have inflation. And I took that conviction and said that this temporary thing was nonsense. You know, this is not going to be temporary. We're going to have a significant inflation here unless, you know, Jay Powell and the Federal Reserve get that money supply under control.
How did Janet Yellen at the time, how did Powell get it so wrong? Are they coming from a completely different school of thought than the Milton Friedman school?
And that really, Nick, is what so disappointed me. I mean, there's 19 members on the Federal Open Market Committee. Now, certainly, I wouldn't expect all of them to have studied Friedman and be monetary economists. You would think there would be some voices that would say, hey, look, we're having an explosion of money. History tells us this is followed by higher prices. I was really deeply disappointed in the Fed. I was like one of these lone voices. Oh, monetarism, you know, that's passé. You know, we have new theories of how inflation works. Well, I'm sorry. I think the old theory's time tested. I mean, Professor Friedman did not get the Nobel Prize in monetary theory and economics for nothing. I mean, it was well-founded research.
Well, speaking of the Nobel Peace Prize, you had a famous quote that ended up on CNBC and all over the place, one of my favorite, where you said giving Jay Powell the Nobel Prize would be like giving one to a drunk driver who hit a pedestrian, but managed to drive him to the hospital and saved his life.
Yeah, that's exactly right. You know, everyone said, oh, isn't Jay Powell doing such a wonderful job? You know, they called it the immaculate disinflation. You know, we're going to get down inflation. We're going to have no recession. Almost no one has done that before. You know, we should give him the Nobel Prize. And I said, we wouldn't have had the inflation in the first place if he didn't screw up. So, you know, you're again like, okay, he's done a decent job getting us down, although I wish we went a little bit faster on the down the side of moving interest rates. We can talk about that later if you want. But nonetheless, I mean, he was the cause of our problems to begin with. You got to look at the whole picture, and he doesn't deserve an A here.
So, Professor, you were on CNBC just a few months before the Fed recently cut. They went down 50 basis points, which is a lot more than many economists said. Was he listening to you? Because clearly you were ahead of the ball. You said that's what he should do, and he did exactly what you said he should have done.
I even said he should be more aggressive. I was very worried when some of the weak data was coming in July. I said, oh, man, this is the start of something. Now, that data has since become stronger. Okay. But even with the stronger data, we are 100% towards our employment target, 4.2%. We are 80 to 100% towards our inflation target of 2%. And until, last week, we hadn't moved a dime. And that made no sense to me. And I really attribute, I think, Austin Goolsbee, who's the president of Federal Reserve Bank here in Chicago, and he's a good economist at the University of Chicago, and I think he reoriented. Now, Chairman Powell, he says recalibration. What that is we're going to start thinking about the fact we should be closer to our target. We don't have to wait for bad data. We should be moving towards our target because we are achieving our target.
So do you think the Fed should be closer to where the 10-year is? The Fed thinks they lead the 10-year, but it's really the 10-year leading the Fed, isn't it?
Yeah, and the 2-year and the 5-year and all those others. I mean, just to give you an example, as we're speaking right now, Fed funds futures for July of next year, which will reflect the June meeting, which is mid-2025, is at 3%. Now, that's a little bit of an underestimate of what the market thinks for various risk reasons, but the market really thinks that minimum, the Fed should be in the mid-3s by the middle of next year. The market has been saying there's no reason to keep this term structure inverted for as long as it has been inverted.
So what data were you looking at when you were calling for the Fed to aggressively cut? You still are. What data points are you watching? What's concerning you the most right now?
Well, at that time, I saw jobless claims go above what I call the safe range of 240,000. I saw unemployment jump suddenly from 4.1 to 4.3%. And I said, I don't know, it might come back, and I hope it does, but you're just too far away from where you have to be. Let's try to get closer to that. I mean, there's a Taylor rule after John Taylor, is a very famous, well-known Stanford monetary economist, who was also Secretary of Treasury. And his rule that has been followed by many, and by the way, was telling Jay Powell to start raising rates way before he did on inflation. But his rule was we should be under 4%. And that was, 3 months ago. So, I said, when I saw that weak data coming in, I said, hey, guys, let's, there's no reason to take risks right over here. All the models that I follow say the Fed funds rate should be near its long-term target. Move aggressive.
Well, WisdomTree and you in particular were ahead of the curve with housing data because of a lot of the housing data is in reverse. It's backwards looking. And you guys explain the metric that you watch that's more forward looking.
Yeah, absolutely. And, it's very interesting you should bring that up. It appeared to me, and this was another failing of Jay Powell, that the Fed wasn't aware that the shelter data collected by the BLS and what is put into the consumer price index is so lagged, is so unrepresentative of what is happening on the ground. If you use real-time indicators, such as apartment list, Zillow, and there are several others, you were getting that we had much more inflation in shelter early, and it had already virtually disappeared really almost 2 years ago. And by the way, let me say, how important is that? Shelter is nearly 1/3 of the consumer price index and 41% of the core consumer price index. Now, it's a lower percentage of that PCE deflator, which is what the Fed looks at, but the real, the core CPI is what many economists say is a true measure of inflation. And they were just using a very lagged, outdated way of looking at it. They didn't capture the upturn, and then they were way lagged, thinking there was still shelter inflation by the time rentals had stopped going up. And we at WisdomTree have an ongoing plot using current data and the BLS data. And when we use current data, either from Zillow, Partnerless, or other sources, we actually get year-over-year inflation below 2% at the current time.
So this brings up a really important question for myself, for a lot of our clients. We've seen a ton of these revisions with the job numbers. Can you even trust the government data that's coming out?
Oh boy. I mean, that's a bad piece of data that, as time went on, it seemed like they began to say this is lagged. I mean, I was shocked because there were some questions early on in Jay Powell's press conferences about, are you using lagged data? And he said, well, this is the official data. And then later on, he said, yes, the official data seems lagged and we're waiting for the real data to catch up. That's why he actually divides what was called the super core, which was excluding that type of data. Now, but you're asking a good question about trusting the data. It is a little disturbing that the response rate to the collection of some of these data has gone down. It went down during COVID, but it hasn't really recovered post-COVID. And this is particularly true for the all-important employment report. Now, it's not seriously deficient here. I'm not trying to say it's worthless data or anything like that. But no, honestly, I think the government should actually require it, because it is the most important reading of the economy. Other data points have different degrees of response rates. The worst deterioration is actually the JOLTS data, job turnover data, job openings and labor turnover a survey, what JOLTS stands for. That response rate, I believe, is actually around 30% now. And pre-COVID, it was 60 to 70%. The employment report used to have an 80 to 90. I think it's 70 now. Now, these are numbers off the top of my head. I'm giving you an idea of what has happened. We need to have good data, but all that said, the data that we have does provide very useful information for investors and the Fed.
Speaking of data points, the consumer confidence report was way down this last time. Is that a contraindicator, though? It looks like it almost works in reverse of the stock market in a lot of periods.
It's a little lagged in terms of that. I mean, and that did puzzle me a little bit because we economists have found the two most important things affecting consumer confidence are stock prices, which are doing real well, and gasoline prices, which are going down. I don't know. People are upset about, the presidential election or what they see might be coming forward or something else. There's always noise in this particular data. But outside of that confidence number, I don't put a lot of stock in that confidence number. I mean, I look much more at, for instance, the jobless claims data, which I think is a really important piece of data, and the other real economic data. And I look at real-time data, such as commodity prices. That's also very important in terms of looking at the pulse of the economy and other market variables.
Well, and isn't there a difference, too, between how consumers kind of think about inflation versus how economists think about inflation, where, yes, inflation's down, but prices are still higher than they were pre-COVID, and that's where everybody's going to the grocery store.
We economists and most of us understand the difference between levels and rates of change. The public doesn't always understand. When Jay Powell said inflation was temporary, it was a little bit confusing. Inflation could go to zero, but then prices stay up. He was actually thinking that because of supply chain problems, prices would go up and then back down. Well, not with all the money that he printed. So the public is upset about the level of prices, even if prices aren't going up anymore at the rate that they used to, they are much higher, and they're not going to go down to that rate. Since, what should I say? Since World War II, except for a few months, the consumer price index has never declined. So it's a matter of going up at a more rapid or at a moderate pace. It isn't like it's going to go up and down and you're going to be even at some point in the future.
For all of our younger clients who are looking at housing, they're renting right now. They thought, oh, maybe I'll buy a house in a few years if prices come down. Then rates went up and prices really have not moderated because there's no inventory. Where's housing going from here? Are we going to see any relief?
This is another thing that I couldn't believe that the Chairman Powell and the Fed wasn't looking at. The 2 years between March 2020, and that was exactly the month that COVID started, and March of 2022, we had a 42% increase in the Case-Shiller Home Price National Index. You take some areas, like Florida was like 80%, and some of the other areas were even, coastal areas were even much more. Everyone was getting a vacation home or whatever. And but nationally, we're talking about areas that didn't really, Iowa, Kansas, Nebraska, that never had that. We had never had a 2-year period in U.S. history, even during that tremendous housing boom that preceded the financial crisis, where home prices went up that much. And in addition to that, mortgage rates, of course, went from 3% to almost 7%. Our index, and we compute here at WisdomTree an index of what's called the cost of buying a home and financing it with a fixed rate mortgage, has since 2020 gone up 120%. Wages have gone up 20%. Now, the average person now is just being priced out of the market. If you don't already own a home, unless you're like in the top 1% of earners, it's almost impossible to qualify for the mortgage and buy a home today.
Is there going to be any relief coming for a lot of these home buyers or people looking for homes?
Well, I will tell you, short-term interest rates are going down. Long-term interest rates are not going to be going down. And the 30-year fixed rate mortgage is based on the 10-year government bond rate. Not one for one. There are other factors. But I'm not expecting mortgage rates to decline much, if at all, as a result of the more aggressive Fed stance. Home prices by Case-Shiller have cooled off. We're back to a kind of a 4% national rate at the current time. Others actually say it's a little less, depends on what index you use. But that financing rate is not. Now, if you choose to take a variable rate mortgage, adjustable term mortgage, those rates will go down because they're tied to the short-term rates. But you expose yourself to that great risk that if we have another rate surge, your monthly mortgage payments might go up quite significantly.
Does the Fed's response and the government's response to COVID the past couple of years, with all the money printing, with all the mismanagement, does it cause you to look back and say, we've just got too much central planning in general? We've got too much power held at the Federal Reserve to the point where we should go back to a gold standard or even the Bitcoin standard like people are talking about now?
Well, there was mismanagement, very certainly. I'm not a fan of the gold standard. I've studied it a lot, and although it does prevent long-term inflation and inflationary bouts like what we had, it really is a straitjacket for governments when we really need to provide liquidity. Listen, let's talk about COVID. There were 4 government fiscal programs that injected money into COVID. When it happened, there was a bipartisan, and Trump was president, who signed away, was all for it, and I'm all for that. We didn't, things were at a standstill. No one knew how serious it was going to be. I have no fault there. Trump then had a second one. By then, I was already saying, do we really need that one? Then Biden had two more that were even bigger than the two that Trump had, and the economy was already roaring back. I said, we don't need these. And Chairman Powell was just printing the money and handing it to the government. At least what Chairman Powell should have done was tell the government, go to the bond market and borrow it. Because if he had said that early, interest rates would have gone up earlier. And if they would have gone up earlier, we would not have had the degree of inflation that we did have.
So where we're at in the economy today, where do you put recession odds? Do you think we've got a recession looming here? When's it going to happen?
Okay. The bold move by the Fed and the new plan, the so-called recalibration, we use Chairman Powell's term for let's look at this a little differently, a little bit more like I was looking at it, has lowered the risk of recession. I mean, I can give you numbers. I would say before this recalibration, it was 35%. I would say right now, looking at the path downward, and if we get to that 3.5% approximately by the middle of next year, I would say that probability is probably down 15%. And you can never eliminate a probability that some shock will occur to the economy that could cause a recession. So nothing goes to zero. And unless you're in one and know it, nothing really goes to 100%. But I do think that the Fed now being more aggressive and that those Fed funds markets indicating that they expect him to do it. And don't forget, Chairman Powell doesn't like to disappoint markets. If he thinks markets are not interpreting what the Fed's going to do right, he speaks out about it right away. He is not yet. I'm not saying he won't, but at this point, he is sort of by his silence ratifying the bond market, the Fed funds futures market, and saying that we see where you're going. And at this point, we're not disagreeing with what you're seeing.
Professor Siegel, we're in the middle of our due diligence program we run at Stenger Family Office. You guys are a huge part of that. We'll end up interviewing about 30 outside asset managers, and we're well into the process. So I would say, Sam would know better than me, but we must have had 19 out of 20 people now say add duration to the bond portfolio. What does WisdomTree say? What does Professor Siegel say?
We're going to be one of those outliers, aren't we? No. I know it's the Fed is lowering rate and they say, oh yeah, well then I better get out, longer. No, and let me tell you why. All those expectations of lowering rates, in fact, more aggressive than what I think is actually going to occur, is already built into that bond rate. In fact, I said the day it was going to happen, the bond rates were going to go up, and in fact, they've gone up since then, and then I think they're going to go up more. Don't forget. A lot of the bond buying was because they thought there was going to be a recession. The Fed was too slow, and you want to own bonds in a recession. If that risk is down, people say, hey, why should I just do, there's so many better assets than bonds. I don't have to buy that insurance policy anymore. Now, again, anything could happen. If we do fall into a recession, all I said was a recession risk were lowered. I didn't say they went to zero. If we do have a recession, your bonds will pay off. But don't think that it is because the Fed is becoming more aggressive at lowering rates. In fact, that is an argument for getting less long-term bonds, not more long-term.
Which I want to point out, back in 2021, when we interviewed all the other asset managers, you guys were the one lone voice in the wilderness back then as well. So it worked out.
We're doing that. We can't guarantee we're going to get it right all the time, but I've studied economics all my life. That's what I do, and that's what I see in the economy and in the markets.
What about China? China passed a bunch of stimulus here.
Right.
Are you a buyer of Chinese stocks?
I'm thinking of it. I heard David Tepper this morning, and he's a smart guy, and he was. He said what convinced him was not just the moves that they took on the monetary side, but now the fiscal moves. But I'll tell you what convinces me the most, not just what he says and all the rest. You're buying stocks at 10 times earnings. When you buy stocks at 10 times earnings, wow, you don't need much to happen to do well. I mean, I often say if you buy a 10 PE stock, even if it doesn't grow earnings, as long as it doesn't decline earnings, you're going to do real well. In fact, if you do the math, if you buy a 12 PE stock that doesn't have any growth to it, but doesn't have any shrinkage to it, you're going to beat the S&P 500 in the long run. And that's pretty hard to do, as we all know. So once everyone's down on Xi. Xi's made a lot of mistakes. I don't think he's a great premier. Who knows? I mean, I'm not a China expert. I'm not, is he going to attack Taiwan or not? I cannot answer that any better than anyone else that has knowledge of that system. Oh, I do know that unless he's going to put the whole private sector out of business, when you buy 10 PE stocks, that generally proves to be a wise choice in the long run.
What about the rest of international, whether it be Europe or Japan? You see this constant story that modern monetary theory, all this money printing massive deficits is going to boost growth long term. It usually doesn't. We've seen Europe be a disaster for equities. And so how are these places going to turn it around and get supply side economics working again?
Yeah. Well, Europe is interesting now. Europe is not as cheap as China. Europe is selling probably around 13, 14, depending on what you look at it, well below the United States. There's more talk in Europe before about why are we falling behind? Why is the U.S. just doing so well? One of the things that's going on, and this is true of all international, people ask me, Dr. Siegel, why is international lag? And I say, once you go outside the United States, you're in a value world. You're in a value stock world. There's just very little in the way of growth stocks. So, value is underperformed. Now, Europe has underperformed a little bit more than certainly our value stocks, but, not that much. You're going away from the drivers of what has been an extraordinary return over the last 5 or 10 years. And if those drivers are missing as they are in most of the rest of the world, you just will not experience in those. However, as I said, I'm reading more about Europe about saying we need to be more entrepreneurial. We need to be more flexible. We need to attract talent. We need to get our tech systems developed. They do have some biotech there, as we all know, in Europe. And that's good. But there has to be a kind of a change in mindset, change in regulation. Their labor markets are much more inflexible than ours. They need just a better business attitude, a more flexible labor market, and frankly, just be more entrepreneurial.
So before we get into stocks for the long run, I got a real easy one for you. Who's going to win the election, and how is it going to impact the markets this November?
I was asked once about, well, what nightmare do you have? And I said, well, one nightmare I have is that one party controls everything in the government. Honestly, both parties have some very bad policies. If one of the, if we have a Democratic House and a Republican Senate, then whoever is the president has got to go through another party to pass anything. And that is what I call check and balance. And I think that would be the best type of outcome here. I like a lot of some of Trump's. I don't like others Trump. I don't like a lot of Kamala's policies. I do like some other aspects of how she wants to run the government. There are positives and negatives of both. But if you control all the levers of the government, that's when trouble starts, because you don't have an internal check. You need to have another party. I mean, a lot of problems with cities. I mean, inner cities, I mean, they're all Democrats, right? I mean, there is no Republican party. There's no check. I mean, we see what's happening in New York. The mayor just got indicted. I mean, the corruption, when you have no check on power by one party to another, bad things can happen. So I'm not going to, pick the president here, but I'm going to say I would very much welcome a split Congress. and a check and balance.
What are the most damaging or important policies to watch? Is it regulation? Is it taxes? Is it tariffs? What are the things to be watching?
Well, all those, I mean, regulations are a big thing. Listen, there are some mergers that need to be stopped. There are some abuses. We need a Justice Department there. We need an antitrust department. I mean, sometimes, stopping, two supermarkets, medium to small, from merging is ridiculous. I mean, Walmart and Costco are taking all of it anyway, and there's nothing wrong with them, and they're taking it all from, and they don't go after them. I mean, you need consolidation in a lot of areas. There's a lot of competition there, but you need to watch it. I mean, listen, Adam Smith, great advocate of free markets, in his book, Wealth of Nations, he said, when businessmen get together, they often think of ways of how can we, get together to fix prices? How can we, not meet market tests? You have to have a watchdog. You have to have some system there, but don't let that destroy the entrepreneurial system, and don't let that destroy the normal dynamism of an economy that requires, as Schumpeter said, creative destruction. You need, certain industries will fall, certain firms will fall, new firms will arise. And that's the magic of capitalism, and you can't stop that.
Speaking of great books, we do have The Wealth of Nations right behind you on the bookshelf there, but then another phenomenal book, probably our second, right next to The Wealth of Nations there.
I'm honored to be put with Adam Smith, let me tell you.
You're on your 6th edition now, Stocks
Correct.
for the Long Run, but Dr. Siegel, you wrote the book on why stocks outperform. So for all of our listeners, please make the case for us. Why stocks for the long run?
All right. Well, the first edition was written in 1994. That's 30 years ago. I was actually based on research I had done in the previous 2 or 3 years. It was published research, so it had, the imprimatur of the profession. The best people said, Jeremy's dad is right. It is right. And what I found, this is what was really interesting. It was not only that stocks outperform bonds in the long run. I mean, many people said that they should, and they did. They did so by a pretty good margin, by the way, 3 to 4% per year. But what was so interesting was the consistency of the long-term stock return. We always focus on the short term, the volatility of the short term, bear markets, bull market. Oh, is it up 30? It's down 20 and all that. But I found that over 30-year periods, in fact, over 20-year periods, diversified portfolios of stocks had less risk than bonds, which, of course, people think is so stable. But once you consider inflation, bonds in purchasing power terms are not that stable. Those people in the 1970s, you have to have a memory. I go back then. I remember that. Wow, we were at 8 to 10% inflation for a decade. Devastated bonds, and interest rates went from 3-4% to 16. I mean, on a long-term bond, you lost 60% of purchasing power, and then another 35% in value. I mean, it was a devastation that virtually no junk stock could have gone through. I mean, people couldn't believe it. Stocks can withstand those inflationary shocks, and do in the long run. And so the major message that I find in the book is that although stocks are the most volatile of all the asset classes in the short run, they turn out to be the most stable asset class in the long run.
Producer Owen, maybe you can put this chart up for everybody watching with us on YouTube. Professor Siegel, this is, I think, the most helpful chart, probably the most famous chart from the book. I think it's still right in the front cover, right? It's right in the beginning of the book.
It's there. And that chart is that one. I went back further than anyone else, the beginning of the 19th century, 1802 to the present. White line on the top is stocks. Annual average rate of return, what's at 6.9 there? I think we updated through June, 6.8% per year after inflation. Dividends plus capital gains after inflation. You can see how it beats bonds, bills, gold, and the value of the dollar over time. And again, you can see that although there's lots of wiggles there on that white line that represents stocks, those are the great bull and bear markets over time. Look at the remarkable consistency of the returns through the 19th century, early 20th century, and into our new 21st century.
So, Professor Siegel, in closing, the show is called Bullish, and we do have the crystal ball here in front of you. Please look into the crystal ball and tell us, where is the market going over the next 18 to 24 months?
I think it's going up. I think it never straight up, but if I had to bet what we're going to be 2 years from now, I say above where we are right now.
Thank you so much for being here.
Thank
That's
you.
Wonderful. Yeah. Thank you, Dr. Siegel. And thank you, everyone, for listening to episode 22 of Bullish. Remember to like, subscribe, share the show so that we can continue to get absolute legends like Dr. Siegel. And if you'd like to hear more about Stenger Family Office, give us a call, 630-912-8431.